Well, today we're happy to have with us Miles Advisor, who's the principal of Money Planners and a financial advisor. Really appreciate you joining us today. Thank you, Miles.
That's fine, my pleasure.
Now, the question really on our minds is, look, everybody knows about investment property, etc. But is that the only thing you should have in your portfolio? Are there any other options?
Gareth, I do quite a bit of investment property with clients, but when it comes to having a bit more of a diversified portfolio, what we look at doing is using the same principle of gearing, but investing into the share market or equity markets. And the portfolios that we're looking at are designed to be an investment for, say, 7 to 10 years, not unlike the same recommendations I give clients for investment property. And what we're looking to do is maybe double our money over a 10-year period. And these portfolios, depending on the risky or the volatility of the portfolio that you're willing to experience, have since 2015, so it's a long period of time. I'll explain the terminology in a minute, but the 80-20 portfolio has delivered over 10% return. The 90-10 portfolio has done 11.4%, and the 98-2 portfolio has done 12%. So when I'm talking about 80 or 90, that's saying that 80% of the investment is exposed to growth assets. The growth assets are principally based internationally, not New Zealand. While there is some exposure to New Zealand is a very small marketplace, 0.5% of the world marketplace. The target is, if you have your investment returning 10% over 7 years, it's going to double in value.
Right. Wow. So those numbers that you just mentioned, that's annual percentage growth. So, in other words, if you took that money and put it at the bank, at the moment you'd be struggling to get 1%. But Correct. Investing through this, we're talking about 10%, 10%, 10%, and then that compounds.
An average of 10% over the period. Now, there's going to be volatility, and there will be periods when it may even get a minus return. But the holding, of course, is 7 to 10 years, and statistically we can show that in any 10-year period, the portfolio is always positive.
Okay.
So it's not unlike a roller coaster ride. You need to be willing to sit in the seat and go through the ups and the downs, but at the end, this is the type of performance you expect to get.
Right. So I guess in some ways, like, a property market, we haven't seen many slumps, but like anything, don't panic. You just got to sit in, because this is not an investment where you expect to pull your money in put it in 1 month and pull it out the next.
That's right. Exactly the same. And we've been doing investments with property for the last 20 years, and I personally have experienced the ups and the downs, and know that you're not going to just get rid of the property because you're in a down period. In fact, that's the worst thing you can do. So the whole intention is, I like property, minimum of 7 years, ideally 10 years. It's a long-term prospect.
Okay.
And the advantage with it is, like property, or unlike property now, the costs of running the portfolios can be offset against the actual income portion of your investment.
Right. So it's not subject to sort of these same interest deductibility rules that the government's been wrapping around. You can claim here, but you can't claim this type of house. This is your for an investment purpose, so those interest costs are going to be deductible. So, i.e., perhaps the banks are a little more reluctant lending, but you can borrow, which is still pretty cheap at the moment, really, aren't we? A couple of percent to invest in this sort of thing as well, as part of your overall retirement or wealth creation strategy.
That's right. Now, it offers quite a bit of diversification, and you're not putting all your eggs in one basket.
Okay. So just in the question people might be wondering is, well, look, I can't touch and feel it. Is this risky, or how risky is it?
Again, it's only risky if you withdraw when the market's not performing. And in a short period, it may go down in value. And then we can show you statistically that over a 10-year period, as I said, it's always going to be positive. So you're not going to lose all your money. That's the big issue. When people think risky, they think back really into the days when people were investing in finance companies and they lost all their capital. Or they may have invested in 1 or 2 shares and the share market crashed and they decided that they're going to pull out. Then you will lose money. But these are highly diversified portfolios, exposed to, depending again on which portfolio you're going, 4,000 to 6,000 different assets held around the world, highly diversified. But they will, if markets go down, your investment will go down. If markets go up, your investment goes up. But we can show that over time, the investments always go up.
Okay. So in other words, you're minimising the risk by one, looking at it as at least a 7-year and preferably a 10-year. Two, there's ownership in thousands of different types of investment in companies and so forth. So that spreads the risk. One's up, one's down, etc. But over time, they're gradually working their way up. And I noticed you made that comment about overseas market. So the New Zealand share market, relatively speaking, is tiny. So what's the value of investing in the world's markets? Why would we want to do that?
Well, the big thing is no one knows which market is going to perform next year. Regardless of the research houses and what they do, it's still speculation. So the concept here is invest in all markets, in all countries, in proportion to the markets that they hold. So a large proportion of investors will be held in the US, because there's a lot of industries that we just don't have here in New Zealand, and invest around the world. So you'll be exposed to the world market being the US, the North and Western Europe, so you're involved with the UK, German markets, and also Australia, of course, and be exposed to what's called the emerging markets. So we're looking there at places like Brazil, Korea, and in some cases even China, because all these markets have their day. We don't know when it's going to be. And statistically, we can show you what has happened in the past. So this is called evidence-based investing. We're not spotting or trying to pick individual companies. We're saying the market does this, and this is the way we'll invest in the market and let the market do what it does effectively. The research has shown that when we look at the investment marketplace, there's what's called large capitalized companies. They're 2 billion upwards, and what we call small cap companies, which are 3 million to 2 billion, and that's the market that performs. It's that small cap business. And then alternatively, we look at, do we invest in growth stocks, or do we invest in value stocks? The difference being is a growth stock doesn't pay dividends but holds on to its income and tries to grow its value, which is a lot more volatile. Or do we use what's called a value stock, where you invest, it releases its dividends, and you reinvest the dividends into companies. And again, statistically, we can show you which is the best performer, and it is the value stock. But they do have their time in the sun. Right at the moment, growth stocks are a bit stronger. But if we're looking over a 10-year period, we'll find again that the value stocks will outperform.
Okay. Now, here's perhaps a last question. We see things, different companies. I won't mention any names, but they sort of advertise, oh, well, look, we've got the best funds managers. We know this. Invest your money with us. What's the difference then? Or is there a benefit from going the passive approach rather than getting somebody who is actively buying this fund, selling this fund? Do you have any advice, your comments on that?
Against the founders of this style of business are two gentlemen called Farmer and French, who have both won Nobel Prizes, one for economics and the other one for statistics. And their research shows that the active marketplace that you're referring to, only 15% of them outperform the average of the market. And over a 10-year period, most of the active managers have left the marketplace. So, because we're looking for a long period of time, and we're not trying to stop it over a short period of time, the evidence again will show that this outperforms the stock picking style of investment.
So, sort of mathematics over, should we say, arrogance? Like, I'm the best, we're the best.
Yes. And that's why it's called evidence-based. It's all based on research.
Yeah.
So it's really, as you say, a large portion of it is passive, but with what's called overlays. And the overlays are small companies, value-based companies. So while we're investing in 4,000 to 6,000 companies, there has already been a filter taken out of the ones that they don't believe over time will give you performance.
Okay.
But as you say, it's not a trading. You're buying and holding.
Yeah. Actually, one final question comes to mind. I said the last one was the final, but it doesn't seem that common, perhaps among mum and dad investors in New Zealand. Typically maybe you buy your house, you might get a rental property that's probably going to be these days now a new build. But are there any markets similar to ours where mums and dads, investors as it were, actually regularly make this part of their portfolio?
Yes, I worked in the Australian market for a number of years, and it was a standard part of their portfolio construction to have geared investments in the share market. And it just gives you another string to your bow style thing. And it's a bit more liquid, obviously, than buying and investing in property. So when you get to your retirement stage, this might be the part of your portfolio you access first, because you can obviously withdraw funds. And within 10 days' notice, you can withdraw any or all of your investment.
Okay, so our cousins across the Tasman do know a thing or two.
In fact, there's banks set up. Macquarie Bank actually has a whole service designed around funding this style of investment, and they in fact gear their investment against shareholding, so you can actually borrow against your shares. It's not something that's readily available here in New Zealand, but clients of mine have used the equity that they have in their homes as a way of funding this style of investment.
Okay, and interesting those comments about liquidity, because that's always the thing I know with clients of ours that are approaching that time where they're thinking, okay, now we want to start cashing up, but what do you do when? And this is kind of a way to ease into that, because you don't want to do it too early, do you? It's just trying to time it, as it were. So that sounds like a good thing. So if people want to know more about how to add this string to their bow, then obviously money planners. A quick Google search would find you, and you'd be happy to just walk them through and look at their situation and give them some advice there.
Yes, this can only be done through a full advice process. So I need to, and it can be done online, meet with the client, get to understand their circumstances, and then we go through what's called a risk profile to see if the style of investment is appropriate for them, and then what level of volatility they might be comfortable with. If the person is super conservative with returns, and I'm just looking at my screen here, of the conservative portfolio, let's say 50% growth and 50% income over the last, since 2015, that's returned 8.2%. So I wouldn't go any more conservative than that, because the more conservative, it's more income-based, and you're not getting the benefits of the equity markets as such. It's more of a design to produce an income on a regular basis, which is where a number of my clients go once they've retired, and they may look to sell their investment property and invest in this style of investment. They get a good return and a steady income. Whereas you go to the other end, which is 98% growth, 2% income, and that's the portfolio that's been performing over 12%.
Right, okay, so either way, you historically looking at some pretty good numbers.
Yeah, just to give an idea, in the last 12 months, because we do have good years, in the last 12 months, the 80-20 portfolio did 23%.
Wow.
The 90-10 portfolio, 27%, and the 98-2, 30%.
Wow.
In fact, 36%. So there are some very good years, but the average is, we're saying, because it's a long-term investment we're looking at.
Well, we appreciate you taking a few minutes to, I guess, pull the lid off something which is maybe not so visible to New Zealanders because we're not in such a big market like Australia where it's a common part of the investing strategy. Thanks for putting that into some simple terms for our audience. Really appreciate your time and your explanation. Miles Flowers, Principal and Financial Advisor, Money Planners. Thank you, Miles.
That's right.